Okay, I'll gladly follow with our keynote speaker introduction for Mr. Robert Prechter, president and founder of Elliot Wave International. Robert Prechter has authored 18 books on finance and socioeconomics, including Conquer the Crash, a New York Times bestseller. Since founding Elliot Wave International in 1979, he has focused on applying and enhancing the wave principle, Arne Elliott's fractal model of financial pricing. He shares his market insights in the Elliott Wave Theorist, one of the longest running financial publications. And as a follow-up, warm-up introduction, our chairman, Richard Smith, would like to share a few words. Richard, are you with us?
I am here, Ron. Thank you so much for your great hosting. And just wanted to say how excited I am that Bob Prechter can join us again. It's really a rare opportunity to hear from Bob today. He's been semi-retired, and his last couple of talks have been the most popular talks on our YouTube channel. Back in 2021, we've gotten over nearly 50,000 views on that talk right now. And every time I talk with Bob, every time I hear from him, I always come away with things that I have never thought about before. I just think Bob is one of the most original thinkers in the financial space, really thinking outside the box. And so, Bob, welcome. It's great to have you with us, and I'm excited to hear what you're thinking, given everything that's going on in our world today.
Well, thanks for that. I always like talking to cycles people, because cycles and wave people have been talking to each other for, I don't know, 50 or 60 years, and it's nice to be part of the group.
Well, we're so glad to have you, and I'll let you take over the floor, but really looking forward to your talk, and thanks again for joining us.
All right. Well, we're going to start by looking at some slides here. Let me get my slideshow going. My topic is Levitating Optimism in the Stock Market. And why did I choose that title? Because we've not only had extreme optimism recorded numerous times in recent years, but it's been very persistent. Even the low in the stock market back in October of 2022 had a very mild degree of pessimism associated with it. So let's do a quick review of what it looked like in 2021, and then we're going to look at some indicators that tell us what's going on right now. So the optimism in 2021 was across the board in every indicator. In fact, in December of that year, in the Elliott Wave Theorist, I showed about 25, I believe, indicators, every one of which was making historic new readings reflecting optimism. So let's just look at a few of them just to give you the flavor of what 2021 was like. On the left, you can see a chart that showed at that time the S&P 500 was priced at 3 times corporate sales. That's not profits, that's sales. Over on the right, you can see that it was selling at twice the quarterly US economy at the time. We had record margin debt. In the previous times that the market peaked out, we also had record margin debt. That doesn't necessarily mean it has to peak then, but it's certainly in the type of overextension of credit and debt that you want to see at the top. We had all-time record lows in cash holdings at mutual funds, that's the middle chart, and at the Ridex funds, which we keep separately. Both of them were around 2% cash. That was the lowest percentage of cash that these managers had ever held. And in the past, if you got down to 4%, it was very extreme and indicated a market top. And back in 2021, it was as low as 2%. One of the amazing things that happened back in 2009 through 2021, actually into early 2022, was the adoption of a manic mindset toward Bitcoin. It was a new thing at the time. In fact, in the Elliott Wave Theorist, we wrote it up when it was only 6 cents. And it wasn't, my acumen that did that. My son was into it. And he said, this is exciting. It's got a hell of a lot of prospects in terms of becoming a currency. So we wrote it up, and then we had no clue. It started at a penny back in 2009, and it went all the way to $70,000 a coin, which is a 7 million times multiple. But people think, oh, it was a separate phenomenon. It was not. It was another indication that social mood was getting more and more positive. And as social mood gets positive, a lot of things happen. One of them is people bid up assets. And you can see throughout the entire move up here that we were labeling primary wave 5, which is now in some doubt. That's when Bitcoin went crazy. And the amazing thing about it is that Bitcoin topped in January 2022, the exact same month the Dow did. So they were concurrent bull markets run by the same manic fever. Now, even in the last few months, we had some speculative fever show up in an area that we could hardly believe existed. And it was NFTs, non-fungible tokens, which are basically zeros and ones that if you press the right buttons, show you a colorful cartoon. And people were bidding these things up to $1 million a piece. It was a craze for a very short period of time, all of which occurred in 2021. And as you can see on this chart, at the bottom chart, on January 16th, 2022, that was the peak in worldwide searches for NFT. And that occurred just 3 days after the high in the New York Stock Exchange Composite on January 13th, 2022. So all these things are really manifestations of the very same human psychology, the desire to speculate. Well, the question now is, has anything changed? And a lot of people feel that the market's very different from the way it was then, and I'm going to show you that it's not. All right, this is an interesting ratio. It was suggested to me by my friend Peter Eliades. We call it the speculative conservative ratio, and it's simply the NASDAQ 100 index divided by the Dow Jones Utility Average. When people are feeling very speculative and they want to take risks and they want to buy things that they think are going to go up a lot, they buy NASDAQ stocks. When they're conservative and they want something that pays dividends and is more or less controlled by the government and regulated industry, they'll buy utilities. As you can see, way back in early 2000, when the NASDAQ 100 to Dow Jones Utility Average topped out last time, that was an extreme ratio there, and it led to a 9-year bear market. The NASDAQ went down 78%, the S&P as shown here went down 57%, and the ratio went down 82%. Well, it went all the way back up and made a new all-time high in 2021, which was a remarkable thing. But here in late 2023, early 2024, we've got yet another all-time high in the speculative conservative ratio. So people are going berserk on a relative basis. Between these two indexes, they are preferring the NASDAQ 100 by miles. And the new high was reached without the S&P even getting to a new high. And in fact, the NASDAQ composite is still not at a new high, and yet this ratio is. We can also look at tech performance versus the S&P 500, which isn't as a conservative ratio, but still they're preferring tech stocks way over the S&P 500. It's a new record in this ratio as well. And this history goes all the way back to the 1930s and shows you the last time people were crazy was 2000. And the time before that was 1968. And we've dwarfed those multiples in recent weeks. Now, all stock markets around the world, in my opinion, are overvalued and overpriced. But isn't it incredible how much more the US market is overpriced relative to global equities other than United States stocks? And that's what this ratio shows you. You can see way back in 1972, when the Nifty 50 were big, the US was really popular back then at about a 1.6. And then the internet bubble that topped in 2000 wasn't even at that level. But now look at the upper right, and you can see we've got a 2.8 multiple now. It's absolutely insane. So U.S. equities are way overpriced. It doesn't guarantee that they're going to turn down tomorrow, even though I think virtually every day has the potential for that. It just tells you this is the kind of environment you're in. Stocks are expensive. And this is one of my favorite charts. I've been showing this for, I don't know, 30 years. On the x-axis down at the bottom, we have the S&P 500 annualized dividend yield. And on the y-axis on the left, we have the S&P Industrials price to book value ratio. And you can see that the box toward the bottom of this chart used to be what would have been called the normal range for stock market valuation. From 1927 until 1988, which is 61 years, the prices stayed within that box in terms of both metrics of valuation. And then they started breaking out, and they went up and up and up and up. And if you'll look very carefully, you can see at the top of the chart where the year 2021 is marked. And about an inch below that, you'll see 2023. That was the close that just occurred this year. So even though 2021 has dwarfed everything else in terms of extreme valuation, the close of 2023 is the second most extreme valuation by these two measures. CNN keeps its own fear and greed index, and it's currently pointing to extreme greed. But here's one thing that people haven't noticed about their index. One of the indicators is whether or not bonds are popular, because they think when bonds are popular, people are being conservative. But these days, that is not the case. People are as bullish on bonds as they are on stocks. And the proof of that is that the yield in junk bonds is still very low. So I think even this extreme greed reading understates what we're looking at. That needle should be almost at 100 at this point. All right, you might wonder, okay, who's bullish? Maybe it's just the institutions, pretty much as it was back in 1972 when the Nifty 50 were running the show. Well, let's see. Futures traders are definitely bullish. This is a chart of the VIX index. Now, the VIX is billed as a volatility index, and they tell you that it measures people's thoughts about the future volatility of the stock market. Well, this is nonsense. It's simply a current time reading of people's complacency versus their fear. When the VIX is very low, people are complacent. They don't think anything could possibly happen. And when it's high, they're afraid and the market is volatile. Now, this scale is inverted. So the higher it goes, the lower the number and the more complacency you have. We've recently been reading the most complacency in over 4 years. It's right about at the levels back in 2019 and early 2020, just before the market had one of its fastest sell-offs ever. In fact, over those 5 weeks, I believe it was the fastest decline ever. That doesn't mean we're facing that right now. It just tells you futures traders are complacent and bullish. Well, options traders are certainly bullish as well, and this is just one of the many indicators we could show. It shows that there is an absolute boom in trading same-day expiration options, which I think are insane. They come on board in the morning and they're going to expire at the end of the day, and people are actually trading these things to the point now that the volume in them is half the volume in all the S&P options, which is just ridiculous. So they're bullish too. They've got the fever. Commodity trading advisors are bullish too. They're currently at a record dollar commitment to the U.S. stock market. They were worried about the market just 1 year ago in December of 2022, and now they absolutely love the stock market. This graph here shows the S&P on the top. It shows the Investors Intelligence Advisor Survey in the center, and it shows the National Association of Active Investment Managers Exposure Index on the bottom. The middle chart shows you that advisors are bullish as well. In fact, the bullish percentage of advisors, that is divided by anyone with an opinion, that's bulls plus bears, is it's virtually 77%. which nearly matches the highest reading of 2021, which was 78. You can see there that at the all-time high in the S&P and especially the Russell 2000 and Value Line, the broad market, it was only at 72.8, and now it's 76.9. So they love the market even more than they did at top tick 2 years ago. And at the bottom, you can see that the investment manager exposure index, it's recently pulled back, but just a couple of weeks ago, it was at 102. That meant they were leveraged long. They don't do that very often. You have to go way back to 2021 to see that, although there was a brief blip at the July high last year when they got to 101. So at tops, investment managers love to be leveraged long. It's the opposite of what they should be doing, but that's what they do. So they are currently very bullish as well. What about individual investors? You guessed it, they are bullish out of their minds. You have to go back to 2021 to see an equivalent reading of the percent bulls among the American Association of Individual Investors. And one thing to know about this group is that they're extremely conservative. They don't usually get very bullish. They're one of the few indicators where optimism is not rampant virtually all the time. But in recent days and weeks, they are as bullish as they've been almost ever, more bullish than they were at the all-time highs in late 2021 for the broad market. If you look at this very closely, you can see that it was down around 45% then. Now it's 60. Commentators are bullish across the board. You see covers like this, feeling bullish. You see people on YouTube telling you which stocks are going to make you a millionaire and that are going to be worth trillions of dollars. These things don't happen at the 1974 low or the 1988 low or the 1982 low. They happen near tops. This is a collection of headlines that Steve and Pete, my colleagues, put together from various places: Financial Post, Market Watch, Yahoo, Bloomberg. They're all telling us we're going to 5,000 in the S&P. Bets on S&P record grow. The Wall Street throws caution to the wind, et cetera, et cetera. Oh, we've got even more. Look at all these. Record highs are coming. And now record highs aren't that far away, so that's not big of a call. But we've got the stock market will soar 20%. Goldman's raising his forecast, very bullish year, and so forth. This has been across the board and virtually everywhere you look. So there's a consensus among people writing about the stock market as well. And there are bulls in places you might not think to look. There's a famous indicator called the hemline indicator. It was actually developed back in the 1920s by an economist who noticed that skirt heights tended to rise with the stock market. Well, recently, they were wondering whether they should bring back mini skirts, which were big at the 1929 high and again in the 1968 high, and in the late 90s as well. But they decided we don't need no stinking skirts, so they call it the no pants look. This is not only on the runway, but some celebrities have been sporting it as well. So you can't get an indicator more frisky, optimistic, and what we might call in the financial world overbought than that. All right, let's take a couple minutes and look at some Elliott waves. Now, I'm going to take you back in time a little bit and show you some charts that I was showing in February 2016, because that was the last, or one of the times in recent years when I was very strongly bullish. The market's been so overpriced for so long. I've mostly been bearish, which hasn't been good, but there were times like in March 2009 when I recognized a low, and here in February 2016. But I want to show you why that looked like a bottom to me and was a bottom. This is a chart we showed at the time. It showed that the New York Composite was one of the weaker indexes at the time, and it had completed a 50% retracement of the previous advancing wave. and it was in a trend channel. It hit the bottom of the trend channel, a nice ABC zigzag, as you can see on the upper right. But that's not all. It wasn't just form. When we looked at the internals, we could see evidence of panic and worry. As you can see toward the left, we had trends of 3.55 and 3.12. And in the decline over to the right, we had 3.29, 2.97, 1.98, 2.42. So people were selling with some intensity. And the really striking numbers on this chart are the advanced decline numbers. You can see toward the bottom of wave A, in the center toward the left there, the max of negative AD. This was a closing daily reading, by the way, was 0.052. That meant there were 19 stocks down for every one stock up, 19 to 20 stocks down. Well, when we got over in the wave C decline, we also had some extremely low AD readings, 0.099, 0.123, 0.031 intraday. Those are the kind of readings that tell you that people were in a panic. And those are the kinds of readings I want to see when I'm looking to try to find a bottom or call a bottom. If you look at the graph at the bottom, you can see that the DSI, which is a Jake Bernstein indicator, by the way, was at 8.8. It was the lowest reading since March 11th of 2009, which was just 2 days after that major bottom. So people were worried, they had panicked, and they were worried, and it was not that tough a call, even though I was basically, a long-term bear. I looked at this and said, no, man, they're going to make a bottom here and they're going up. Well, why did I show you this? Because we have seen absolutely nothing like this in recent years, the last 2 years. We've had a setback in prices, but no worry, no panic, no super trends, no super AD readings. And you could look, this is a picture of the Russell 2000 index. It topped in November 2021. Now, if it were anything like February 2016, where you see a circle 1 there, I would have put A, and then I would have put a B on the rally and a C over to the bottom right, where we currently have a parenthesis B, and said, okay, that's a bear market, we're done, or a correction, we're done, and we're ready to go to new highs. Since we've seen absolutely no indication that anybody is particularly worried, we're still in the manic mindset. Now, there are some difficulties with this wave count, and I noted them there on the bottom right, which is that 4 overlaps 1. It's an intra-week overlap. It's not very big, but it does exist. So you have to do your best with this and decide, well, what are we going to do with it? I think 5 waves down is the best way to count this. And A, very long B, and then C upward is the best way to count the upward correction, which looks to me like an upward correction. So we're counting this as primary 1 down and primary 2 up. I think this makes sense with all the optimism that we've seen, all the sentiment indicators we just went over. They're suggesting that people are really bullish. I don't know if you've read Elliot Wave Principles that A.J. Frost and I wrote way back in 1978, but there's a line in there that says, in second waves, the psychology is repeated, or the market relives that psychology that existed at the previous major turn. Well, the previous major turn was November 2021. And again, you can see that we're seeing the same type of psychology, people bullish out of their brains. So I think this is fitting the description of a wave 2 upward retracement. Now, it's interesting, even though the Dow's made a new high and it's made headlines, the Dow divided by the PPI, which some economists would call an inflation-adjusted Dow, has this pretty much a clear bear market profile, much like the Russell 2000, but without any of the overlap problems, as you can see here on the monthly close chart. 5 waves down, 3 waves up. So I think from that basis, the best interpretation of the overall stock market is a wave 1 down, wave 2 up finished, and everybody's bullish because it's a wave 2. Now, what about the nominal Dow? The nominal Dow has made a new all-time high recently. This is a big headache for me because I was convinced that 2021, early 2022 was it. especially in terms of time, Elliott wave time considerations, which we discussed, I think, here in the Foundation for the Study of Cycles last year and the year before. We're not going to go over that now, but you can see here that we had a flat correction on the right-hand side chart back in 2000 to 2009. And you can see that it started the 2000 to 2002 period with a bunch of overlapping waves on the downside. And then it had sort of a really dramatic B wave to the upside before being completely retraced by wave C between 2007 and 2009. If you look over on the left, you can see we had a very similar bunching formation from in 2022, from January to October. And we've had what I think is a B wave since then. Now, there are ways to identify a B wave other than simply wave structure. One of them is what's going on internally. And what's going on internally is a whole slew of divergences. And we're going to look at a few of these right now. This is a study of the Dow versus the broad market. The top chart shows you the Dow Industrial Average, nominal Dow. The middle chart is the Russell 2000 Index. And the bottom graph is the ratio of the two indexes. So you can see the Russell 2000 divided by DJIA has been weak ever since the summer, actually, of 2021. And the latest rally hasn't done much to change that. So the broad market is lagging terrifically. And if you remember back in 1972 to January 73, the S&P and the Dow were both making new all-time highs. But the broad market, as represented by the advanced decline line, was lagging significantly. And that's what you've got going on here. Even within the NASDAQ, all right, now we showed you some ratios where the NASDAQ 100, for example, is being bulled up like crazy relative to the S&P and relative to the Dow Jones Utilities. But even within the NASDAQ indexes, you've got a lot of selectivity. There's been a lot of talk, as you know, recently about the Magic 7 stocks that everybody wants to own. And they are actually overwhelming these indexes. So here we've got the top graph on the NASDAQ 100. We've got the middle graph, the NASDAQ Composite. And as I mentioned a little bit earlier, the NASDAQ Composite has not made a new all-time high, and maybe I should say yet. We'll soon see. The 100 has made a new high. But look at the bottom graph. This is the ratio between the two indexes. Now, the NASDAQ 100 was actually a bit weaker than the New York Composite since from the top in 2021 until the bottom in late 2022. You can see that even then it was going a little bit down. But look what's happened during the rally. The relative weakness has exploded, just taken off. And it shows up here by a steep decline on the lower graph. So we've got tremendous relative weakness in the composite versus the 100. And if you just showed those 7 stocks versus the NASDAQ 100, you'd see the same thing. So it's an extremely narrow market, even within the big leading index. All right. Now, Dow theory is probably the oldest technical theory in the United States. It goes back to the 1880s when the Dow averages were invented. But the theory itself didn't come out till later. But the Dow theorists were pretty active in the teens and 20s and 30s and 40s. And the idea here is that if you've got a bull market in force, or for that matter, a bear market, the trend should be broad. That is to say, both indexes, the industrials and the transports, should be going up or down together. And when they start diverging and failing to confirm, let's suppose you're in a bull market, that means failing to confirm a new high in one of the indexes, that is often a setup for trouble. Not a guarantee, but it's a setup. You can see the major bearish non-confirmation that occurred back in 2018 to early 2020, and it led to that tremendous crash February, March of 2020. Well, look at what's going on now. we have a long-term bearish non-confirmation, and it's pretty dramatic and pretty sizable, all the way from the high in the transports in the summer of 2021 until now. It's lagging the industrials significantly. And now look over toward the far right, and you can see the industrials, big new highs in recent weeks, but the transports are lagging even on that basis. So that high, I believe, was back around July, and it hasn't gone above it. So you've got a near-term non-confirmation against a long-term non-confirmation. The low in late 2022 was jointly registered. That means under Dow theory, the trend was confirmed as down. A bear market was confirmed then. And so far, a new bull market has not been confirmed by the Dow transports. So as far as the Dow theory is concerned, unless and until the Dow Jones transports fall in line and make a new high, which they could do, but until they do that, or unless they do that, the Dow theory considers the current situation a bear market. So do I, but I've been wrong about that more than once. So we'll see how this non-confirmation behaves as we go forward. All right, well, this is a cycles group, so maybe we should talk for just a moment about some cycles. I don't show them very often, but every now and then I do a study and say, what's going on? Can we explain, or at least try to explain, the current profile using cycles? The venerable 4-year cycle, I think, is still operating. It goes back decades. And you can see that low on the bottom left in February 2016. That's where I showed you those charts where I turned very bullish because of the panics that were going on. Well, then we had a beautiful low in March 2020. That was 4 years and 1 month later. Well, 4 years and 1 month after that, and none of these cycles are always perfect. They can be off by months. But anyway, an equal distance would bring you to April 2024. And now look at the 2-year cycle that's inverted here because it's showing the distances between extreme tops ever since January 2018. So we had a top in January 2018. 2 years later, a top in February 2020. 2 years after that, a top in January 2022. And here we are in January 2024, 2 years later. So if both of these cycles are operative, which is always a big if, then we should see a high this month, possibly plus or minus a week, because we had that February 2020 high. But that really struggled back in February to make a high above the January peak at that time. So I think January would be the reliable month here on a 2-year cycle. If the 4-year is due to bottom soon, which is to say April 2024, we've got the potential for a crash very much as we had back in early 2020. These are all ifs, but the setup is there. And remember that chart I showed where we had counted the Dow Industrial Average as an A down into October 2022 and a B up into the current area. Well, it's expecting a C down, and this setup suggests the same thing. All right, so we might ask the question as we get closer and closer to the end of this presentation. Where would be a good place to invest? Well, obviously not the stock market, in my opinion. Is there another spot where you might want to invest? I would not invest in real estate. Why is that? Well, we already know that prices are historically high, but why are they historically high? I think they're historically high because institutions decided that this was a new investment area. And this graph shows you the portion of U.S. home purchases made by landlords with 1,000+ houses. These are corporations and investors who think that real estate is a good investment, so they bought thousands of homes. And you can see that they went crazy to buy homes in 2021. And it was the second quarter of 2022, which, by the way, is only 1 quarter after the highs in the S&P, New York Composite Index, Bitcoin, and NFTs, they all topped, and the real estate held on for another quarter, at least in terms of institutional mania to buy the stuff. But it has slackened substantially since, and I personally don't think these people are going to come back. The only reason I can tell you, besides the mania probably being over, that I think it is likely that these institutional investors will not come back, is that I've personally witnessed some of the houses these people own. We had one in our neighborhood, and who moved in but a pair of drug addicts and drug dealers with 3 pit bulls. So they did a number on this property. I think the collateral held by these people, the physical asset that they own, are deteriorating across the board because there aren't any landlords, even though that is the word in this graph. These are corporate owners. They're nowhere near the property. They have no idea what's going on. And I think one day the issuances from above are going to be very brief, and they're just going to say, sell this stuff, get us out. We don't care what the price is, clean the books. It's time to get out. So I think there is going to be coming eventually an extreme set of bargains in the real estate area. So you've got your eye on a dream house, keep your eye on it. If these institutions ever dump this stuff, there are going to be a lot of homes coming available, and that means all prices will come down with them. So I certainly wouldn't be buying a lot of real estate right now. What about so-called high yield bonds, which to me is a euphemism? I like the term junk bonds much better. This is a very long-term history, going back more than a century, and it shows you the times when the yield on triple B, that is junk bonds, was very close to the yield on treasury bills. Those are the lows you see here, or very far away, much higher than the yield on treasury bills, which you see at the tops on this graph. Now, the amazing thing about this, which we've been pointing out to people, is that these tops and bottoms don't occur randomly. They occur because social mood is in charge of the stock market, and it's also in charge of the relative yields in junk versus treasuries. Well, let's look at the top first. Every time the ratio was really high and people demanded a lot of yield from their corporate bonds, were times like May 1932, September 1982, and November 2008. And I'm sure everybody here recognizes those dates. May 32 was 1 month before the bottom in the S&P, after the Dow had fallen 89%. September 1982 was only 1 month after the low of August 1982, which started this whole bull market. And of course, November 2008 was 1 month before several stock indexes bottomed, and about 4 months before the Dow and S&P bottomed. So that's when people were worried. At the bottom, you can see when they weren't worried. May 1929, January 66, July 73, early October 79, February 2007, and May 2023. So it's past May 2023, but people are still not worried. They're extremely bullish on bonds across the board. They're bullish on treasuries. They're bullish on corporate bonds as well, and bullish on junk. So this has not changed. I would not want to own virtually any corporate bonds. All right, because we've just talked about junk corporate bonds, you might be interested to know that the profile in the Bloomberg U.S. Corporate High Yield Bond Index, inverted, is a very close match to the Value Line Composite Stock Index. The Russell 2000 that we showed earlier has almost the very same profile. I think they're both completing primary 1 down and primary 2 up. And that's because people are so bullish. That is the best interpretation of this chart. And the high yield index happens to have a much cleaner Elliott wave without that overlap that I griped about earlier that you see in the Russell 2000. So if they're the same counts, we've got a wave 2 rally in junk bonds, we got a wave 2 rally in the Value Line Composite, and we got a wave 2 rally in the Dow divided by the PPI, the inflation adjusted Dow. So I think we've had this levitating optimism for all this time because of these wave counts that we've been in wave 2 ever since late 2022. And this is regenerating all the optimism that we saw at the actual high. Okay, so what do I think is an attractive investment? In the book that I brought out in January of 2022, which is called Last Chance to Conquer the Crash. In that book, I said, I think the best investments are treasury bills and floating rate notes. Yeah, they're boring. Yeah, currently yield is 0, but I think this is going to change. Believe it or not, the Fed and other economists were predicting that global interest rates were going to stay near 0 for the foreseeable future, whatever that means. But history, I think, didn't agree. History was scratching its head saying this has never happened before. When in history has anybody paid someone to lend it money? It's absurd. So finally, the world sobered up a little bit, and the yields in treasury bills started to rise. Now you might, if you haven't read the book, you might wonder, what are floating rate notes? These are 2-year notes issued by the US government, but they're not like the usual 2-year notes. They are tied to the yield of the 3-month T-bill, and they are adjusted to the T-bill rate every 3 months. So you don't have to go rolling these things over. It's an auto adjustment process. And it's great because you buy them once, you're in them for 2 years, you don't have to worry about adjusting the rate. So these have been going up in yield ever since, we've been in them. The latest yield, I think, is 5.4, I saw yesterday. But that's a terrific return for nothing, for doing nothing and risking nothing, at least in the current environment. These could become risky someday, but they're not right now. And if I can get 5.5% on my money doing nothing and with no risk, I'm a very happy camper. This is a history of interest rates going way back. I'm only showing it because I think it shows the potential for rates to go even higher than they are today. They don't have to. I mean, 5.5 is pretty historically reasonable, but there's a lot of upside potential. And if there's ever a panic in the bond market, I think there's a chance for yields to go far, far higher than they are today. So floating rate note seems very reasonable to me as an investment. Now, this is something I don't think too many people are talking about because they've been talking about inflation so much and how the prices of goods are up and consumer goods and so forth. But the US dollar has been fairly strong ever since early 2021. I think there are a couple of factors involved here. One is that, of course, T-bill rates began to rise, so the dollar became a little bit more attractive if you're going to invest in US debt. Secondly, stocks topped in November. The broad market topped in November of 2021, and that made cash a little bit more attractive than stocks to a lot of people. So the dollar took off and had a really strong move up into the low of late 2022 in the stock market. Well, if you look at this current setup, it's kind of interesting because at the July high in the S&P, of course, the dollar came down because people were back into buying stocks again, right? So they said, okay, who needs cash? We want to be in stocks. Well, the S&P is quite a bit higher right now than it was in July, and yet the dollar is doing a pretty good job holding above that previous low. I think this is yet another non-confirmation or divergence, which is bearish for stocks and bullish for the dollar. Is it going to work out? I guess we'll see, but the setup is there. For gold enthusiasts, I'll let you know we are still positive on gold. We think it's in primary wave 5 from late 2015. You can see our count here is intermediate 1 down, 2 up, 3 up, and 4 down. We think we're still in intermediate 5. So I think some all-time highs are ahead in gold. What I think is going to happen is there's going to be a rush toward cash and money, and gold falls in that category for sure. So I think gold is going to look attractive to people. This is a chart I published back in 2021 as well. It's something that I've never seen anybody chart before. It's the Dow divided by the CRB index. So it's basically stock prices versus commodity prices. This is an insane chart. It starts in 1920 and goes up to 2020. That's exactly a century. And do you know that that commodities, were more valuable than stocks in 1920? And this multiple from that low, we measured it, went up 233 times, which just happens to be a Fibonacci number, into the top of 2020. And we said, look, it appears to have hit a trend line on a yearly closing basis. On the upside, this looks like the end of the great stock boom relative to commodities. And what that means is stocks, these sort of shares of enterprises, relative to things. Well, from that high, the ratio has already started to recede. I think that's the grand super cycle peak in the value of stocks relative to things. I think a major multi-decade adjustment has begun where stocks are going to be less and less of interest to people. I think eventually they're going to go completely out of style, just like they did after the South Sea bubble peaked in 1720. And by 1784, they were making lower lows after 64 years and nobody cared. I think we're facing something like that in the future. And I think things are going to become much more valuable, certainly relative to stocks. So if you can play that ratio, that should be something worth doing. That's about it. My marketing department pushed me to put this up there. If anybody cares to look at the recommendations of where I think you should be invested, you can find it in Conquer the Crash. And if you go to this address, you'll find, I think they have some sort of half-off deal for FSC people. But that's it for the commercial, and that's it for my presentation.
So my opening question to you is on this point of levitating optimism, looking back in history, what historical rhymes come to mind? I know this is probably the big one in terms of the most extreme with the most greed, but what comes to mind initially?
Nothing does. Just consider that the Bitcoin we talked about earlier, a 7 million times multiple. Now, people used to write up the tulip mania. Remember that? I think that was about, I think it went from something like $1 or $2 to 60. That's nothing. It's 30 times. And then it crashed back to the start. This was a 7 million times multiple in something that has no actual intrinsic value. It has value for sure, but nothing, not intrinsic. You can't put it in a flower pot and smell it and say, oh, this is the nice thing that I own here. So I've been wondering about that. When A.J. Frost and I first put Elliott Wave Principle together back in 1978, we were debating. We finally decided that we felt that the 1720 peak was a grand supercycle high, and the 1784 low in Britain was the grand supercycle wave 2 low. So we've been waiting for grand supercycle 3 to top out. But one of the options we showed was it could be a millennial degree wave. What does that mean? It means the last time a millennium degree wave topped was in Rome. Around 350 AD or so. So you have to go back. Actually, the heyday was around 100, I think. But that was it was a multi-century topping process for that civilization. I don't know if we're in something like that or not, but the craziness is really something. One of the things that makes this era so amazing is that we have central banking. We've got it across the globe. It's the first time ever, even in 1929, when we had a central bank, they weren't about to monetize everything in the world. And it was bankers with real money that tried to stave the October 1929 crash, and they couldn't do it. They had to give up. And now you've got these institutions that can do anything they want and print all the money they want. Now, the Fed has been actually reducing money supply recently, which is an amazing thing. And it's also amazing to me that stocks are going up despite that. But still, you've got complete fiat money forced on everybody. And so when we keep our charts, it's a real pain in the neck, as we showed that the nominal Dow is at a new all-time high, but the inflation adjusted Dow isn't there. The Dow PPI isn't there, and Dow Gold is nowhere close. Do you know that the Dow priced in real money, which is gold, is down almost by half? In fact, it's sitting almost where it was in real terms at the top in 1929. There's been no real progress in the value of the U.S. stock market when you price it in real money, which is hard money, which is gold. That's an amazing thing. Nobody knows about it. They think we're all getting rich. And all that's happening is we're adjusting to the declining value of the money. So it's making things difficult, and I think helps explain why things are so positive. Now, I will add one last thing. The Fed is not in control. Central banks are not in control. They look like heroes as long as people are optimistic and bullish and holding everything up. But you remember what happened back in 2007 to 2009. Everybody thought the Fed were geniuses in 2007, and by 2009, academics were writing papers about how the central bank didn't know what the hell it was doing. And that's because people's mindset changed. They went from optimistic to pessimistic, and the Fed couldn't do anything about it.
I mean, what's your sense of social mood with this very strong consensus view of a soft landing? Has it happened many times before, and what's been the lesson from that?
It's just another indicator. You know, if economists are worried, you're probably near a bottom, and when they're complacent, you're on the way up or near a top. And when they all have a consensus, like all those headlines I showed you earlier from money managers and commentators and everybody else, it's an extremely optimistic mood across the board. And that's why economists are pulling back from their previous worries about a mild recession. Now it's no recession. Now, there are people who feel that the 4-year cycle reset and that it really bottomed in October of 2022. So if that's the case, then it's going to bottom and not going to bottom until 2026. That's fine with me. I must await, shall I say, more evidence before I jump on that idea.
And then your view on inflation versus deflation. I know you've had a strong held view for some time, but it's skewed towards deflation. If we could maybe re-clarify that for the audience and any latest thoughts you have.
Eventually, I think all of this is going to end with a deflationary plunge, and I think all of the debt, dollar denominated and otherwise, around the world is probably going to not be paid off, and that's going to be an extreme deflationary event. I don't think the Fed is going to say we're going to monetize every piece of IOU in the entire world. So I do think deflation is still the ultimate outcome. And again, if you're in something simple like Treasury bills or FRNs, and deflation occurs, you're going to be making real money while other people are, losing theirs. And if we have more inflation, I think that the yield in the Treasury bills, unlike previous year, when they were down at zero for a while, are going to track the inflation rate. So either way, you should come out pretty well. What I think I'll end with is just to say that when you get extremes of social mood in one direction, however long it takes, and this has been taking a long time, however long it takes, you're eventually going to see extremes in the other direction. And so I think sometime in the next few years, that is what we're going to witness. And we'll be having another FSC meeting when people are going to be talking about when the low is going to occur because we're already down X%. We'll see.
Robert Prechter, thank you so much for your keynote speech, and we look forward to welcoming you in the future at the Foundation for the Study of Cycles.
Yeah, well, I'm so glad, first of all, to talk to you again. It's great. But also for everything that Richard Smith has been doing with the foundation and all the other people as well. I mean, he's really bringing it back.
Appreciate that support, Bob. And I really appreciate all the information that you bring to our attention. I mean, some of those divergences and ratios are sobering. That chart of those valuations of the dividends versus the book value still is, I mean, incomprehensible.
What the crowd wants, the crowd gets, and it doesn't matter what the fundamentals are doing.
Yeah.
And let me add one other really interesting thing. Cycles were big and popular in the 30s and 40s, 1930s and 40s, again in the 1970s, and then they were dead. Why is that? Because people don't care about cycles when the market is going up. And that happened in the 50s and 60s, and nobody talked about cycles. It's happening in the 80s, 90s, all the way to the present pretty much, and nobody is really talking about cycles. But isn't it interesting that the foundation for the study of cycles is rejuvenating and it's finding new people? I think that is a very subtle indicator that long-term things are changing and they're about to change in a big way. And people are going to get a lot more interested in cycles if we get into a bear market.
Well, thanks again. And we look forward to keeping in touch and talking to you again soon.
That's good.
Ron,
Thank
great
you.
hosting. Good night,
Yeah.
everybody.